Okay, let's unpack this. The world of finance and economics can often feel like a tangled web, right?
Absolutely.
So many numbers, so many headlines, and it's hard to know what truly matters. But today, we're cutting through all that noise.
Right.
We're taking a deep dive into something incredibly important, a detailed global intermarket analysis as of September 1st, 2025. This isn't just about one market, it's about how all of them interact, revealing those underlying currents shaping our financial world.
hmm
Our mission, as always, is to dig into your sources and pull out those absolute golden nuggets of insight, making you truly well-informed on the current macroeconomic environment and, crucially, how different asset classes are moving in relation to each other.
And what's truly fascinating here, I think, is how all these pieces fit together or sometimes spectacularly don't, right?
Right.
Understanding these connections is the real value. It helps you move beyond just knowing what happened to understanding why it matters and, crucially, what might be coming next in this complex interconnected system.
Absolutely. And trust me, global markets are navigating a complex and pivotal moment right now.
Yeah, it feels that way.
We're talking about a tug of war between the Federal Reserve's next moves, the ongoing debate about global growth, those stubbornly persistent inflation trends, and even the constant hum of geopolitical factors. It's a lot to process, but we're going to make it crystal clear for you, guiding you through this intricate dance. Let's jump right into the big picture, starting with what everyone is buzzing about, the Federal Reserve's policy pivot. The market is practically roaring for a Fed rate cut at the upcoming September FOMC meeting. It's not just a whisper, it's like an overwhelming expectation.
It really is.
What's driving this incredibly strong conviction right now?
That's precisely the central question, isn't it? The narrative has fundamentally shifted from if the Fed will ease to how deep and how fast that easing cycle will be.
Right, the magnitude.
Exactly. And what's fueled this expectation are two key things. A noticeable softening in recent labor market data, alongside some decidedly dovish commentary from key Fed officials.
Okay.
This makes all incoming economic data, especially from the labor market, an incredibly high-stakes event. I mean, every new data point could either solidify or, shatter these deeply held market expectations.
And speaking of data, there's a clear conflict when we look at global growth. We've got robust, backward-looking data, like that upwardly revised Q2 U.S. GDP of 3.3%, which, on the surface, sounds like the economy is humming along nicely.
hmm Looks good in the rear view.
But then you look at the forward-looking indicators, and they're flashing warning signs showing significant weakening. It's almost as if the rearview mirror is showing sunshine, while the windshield is, well, covered in storm clouds.
That's a perfect analogy.
Yeah.
This clash creates that tense soft landing versus hard landing debate that markets are incredibly sensitive to right now.
Yeah.
On one hand, you have that impressive GDP number, but on the other, you're seeing a deterioration in U.S. consumer confidence and global manufacturing PMIs consistently showing contractionary pressures.
Contractionary, okay.
Yeah. It's a classic battle between what has happened and what is expected to happen. Any new piece of data could truly tip the scales toward a more severe economic downturn. And that's why everyone is watching so closely for, a definitive signal.
Now, despite all the talk of disinflation over the past year, we're seeing some sticky inflationary undercurrents emerge, which adds a whole new layer of doubt to the picture.
Right.
You highlight those sticky inflationary undercurrents, which certainly complicate the picture, but couldn't a bit of persistent inflation be viewed in maybe a twisted way as a sign of continued underlying demand, preventing a complete collapse in growth?
That's an interesting angle. And, for certain sectors, perhaps it is. However, from the Fed's perspective, especially with July U.S. core PCE inflation, their preferred gauge, ticking up to 2.9% year over year.
Still above target.
Still stubbornly above their 2% target, yeah. It creates a real bind for policymakers. It introduces what we call stagflationary concern, meaning growth is slowing, but inflation remains sticky.
Right. The worst of both worlds, potentially.
Exactly. This situation significantly handcuffs the Fed, making it much harder for them to ease policy as aggressively as the market hopes, because they still have to contend with their primary mandate of price stability.
And as if managing all that wasn't enough, we still have to geopolitical and trade tensions rumbling in the background, like a constant hum you can't quite escape.
Always something.
We're talking ongoing conflicts and persistent trade frictions between major economic blocs. What's their actual impact on these interconnected markets?
Well, their impact is quite profound, actually. These tensions don't just exist in a vacuum. They influence global supply chains, contributing to volatility in commodity markets, especially energy prices.
Okay.
And crucially, they can trigger sudden, sharp shifts in overall risk sentiment, driving what we call safe haven flows.
Safe haven flows, right. That's when investors get scared and run to things like bonds or certain currencies.
Exactly. When investors feel uncertain or fearful about the future, they rush their capital into assets perceived as extremely secure, like certain government bonds or currencies, driving their prices up. These shifts can affect everything from currencies to government bonds as investors seek security above all else.
Okay, so we've got these powerful macro forces swirling around us. The Fed's next move, the growth paradox, sticky inflation, and those geopolitical jitters.
A complex mix.
The real trick, and what makes intermarket analysis so powerful, is seeing how these broad currents actually pull on individual assets. So let's pull back the curtain on how each of our key players from stocks to crypto is responding to these pressures. Here's where it gets really interesting.
Let's do it.
Let's start with stocks, specifically global and U.S. equities. On the surface, things look pretty rosy, right? Global equities near all-time highs. But are those headline numbers telling the full story? What are the underlying dynamics you're seeing in the equity markets?
That's exactly the right question to ask. While stocks are indeed near all-time highs, we're seeing increased volatility and signs of consolidation.
Consolidation, okay.
Critically, market leadership is incredibly narrow, dominated by those AI-related mega-cap tech stocks. This creates a real paradox. Strong headline numbers masking underlying fragility.
So just a few big names pulling everything up.
Pretty much. This kind of narrow leadership, where just the top 10% of stocks are vastly outpacing the rest, isn't historically a healthy sign. It suggests the rally isn't broad-based and could be vulnerable to a quick shift in sentiment. Also, we're heading into the notorious negative seasonality of September, historically a challenging month for equities.
Right, September slump, they sometimes call it. So it's almost like a star player carrying a team rather than a whole team effort.
And how do stocks typically dance with the other big market movers, like interest rates or inflation? We'll think of interest rates as stocks' dance partner. There's a strong negative correlation. Rising rates generally hurt stocks because they increase borrowing costs and, reduce the present value of future earnings. So the current rally is largely predicated on expectations of falling rates.
Got it. Lower rates a bolt for stocks.
Generally, yeah. Inflation's dance is more complex.
Yeah.
Moderately falling inflation is bullish because it supports those Fed rate cuts.
Yeah.
But sticky inflation is bearish because it constrains the Fed. And a sudden deflationary shock, very bearish, signaling a severe recession.
Okay.
Stocks are the primary risk-on asset. Good economic news helps, bad news hurts. And finally, a weaker U.S. dollar is generally a tailwind for U.S. multinational corporate earnings, as their foreign sales translate to more dollars, giving it a negative correlation.
That makes perfect sense. Now, moving over to bonds, specifically U.S. Treasuries, the market feels like it's in a state of high tension.
Definitely feels tense.
The 10-year note yields have been quite volatile, caught between the dovish Fed narrative pushing yields down and sticky inflation data pushing them up. And the yield curve remains inverted, which may be a quick reminder for listeners.
Yeah, good idea. An inverted yield curve is when short-term government bonds actually yield more than long-term ones, a truly unusual situation. Historically, it has often preceded recessions, as it signals market expectations of future rate cuts.
Right. So what's your read on the bond market right now, given all that?
The bond market is a crucial barometer right now. Bond prices have a direct inverse relationship with interest rates, so the entire market is positioned for the Federal Reserve to cut its policy rate, which would lead to lower yields and higher bond prices.
Betting on the Fed.
Essentially. Inflation, however, is the primary enemy of bonds, eroding real returns, so there's a strong negative correlation with inflation. Surprises a jump in inflation means bonds generally suffer. In a risk-off environment, treasuries are the primary safe haven, so you typically see a positive correlation with market fear and a negative one with stocks. Finally, a stronger dollar, often driven by that safe haven demand, can be associated with demand for U.S. bonds, creating a moderate positive correlation.
Then we have commodities, and this complex is truly fractured right now. It's not moving as one block.
Not at all.
Industrial metals like copper are under pressure due to global growth concerns, while oil prices are volatile, balancing OPEC plus supply discipline against demand worries. Gold, on the other hand, has been a strong performer, What's behind these divergent moves?
Gold's performance is largely tied to its strong negative correlation with real interest rates. When real rates are expected to fall, gold, as a non-yielding asset, becomes much more attractive.
Makes sense. Opportunity cost goes down.
Exactly. Industrial commodities, in contrast, suffer when high rates slow economic activity and dampen demand. While commodities are often seen as an inflation hedge, that relationship can break down with sudden supply shocks.
Right.
Industrials are risk-on, while gold is a classic risk-off safe haven. And because most commodities are priced in dollars, there's a powerful inverse relationship with the DXY. A weaker dollar makes them cheaper for foreign buyers, boosting demand.
Let's talk about currencies, specifically the US dollar index, or DXY. It's truly at a crossroads, isn't it?
Absolutely. Stuck in the middle.
It's been pressured by that dovish Fed narrative, but it's found support during bouts of global risk aversion. It's consolidating, kind of waiting for the next big piece of data. How do you see the dollar navigating these conflicting forces?
The dollar's dance is a fascinating one right now because it's pulled in multiple directions. It has a strong positive correlation with U.S. interest rate differentials. So if U.S. rates are expected to fall faster than those of other major economies, the dollar tends to weaken.
Okay.
While high U.S. inflation can initially strengthen the dollar if it signals a hawkish Fed, persistently high inflation can actually erode its long-term value.
Interesting nuance there.
Yeah. The dollar is also the premier risk-off safe haven currency, meaning during global market stress, capital flows into the U.S. This creates a positive correlation between the DXY and market fear, which can actually conflict with the interest rate narrative of a weaker dollar.
So it can go up even if rates are expected to fall, if people get scared enough.
Precisely. And as you mentioned, it's negatively correlated with both commodities and U.S. multinational stock earnings.
Next up, cryptocurrencies like Bitcoin and Ethereum. They're in a period of consolidation after a strong run-up earlier in the year. Still highly volatile and increasingly sensitive to macro factors, especially global liquidity and regulation. How do they fit into this intermarket picture?
Cryptocurrencies, being non-yielding assets, have a strong negative correlation with real interest rates. They become more attractive when the opportunity cost of holding them is low or falling.
Similar to gold in that way.
Somewhat, yes. But they sit at the far end of the risk spectrum, with a strong positive correlation to the most speculative parts of the stock market, like the NASDAQ 100, performing well in risk-on environments.
Got it. High beta risk asset.
Exactly. And because they're viewed by many as an alternative to fiat currencies, there's a moderate negative correlation with the DXY. What's important to remember, though, is that crypto can also decouple due to idiosyncratic factors, regulatory shifts, exchange failures, or specific protocol upgrades, making them uniquely susceptible to their own internal dynamics.
Right, they have their own world sometimes. Finally, real estate, with the U.S. focus. The housing market is showing signs of slowing significantly.
Big time slowdown.
High mortgage rates, a direct result of the Fed's previous hiking cycle, have crushed affordability and transaction volumes. Prices are still sticky in some areas due to low inventory, but the overall trend is clearly one of cooling. What's the biggest factor influencing real estate right now, and what's its dance like with the other assets?
Real estate has a very strong negative correlation with long-term interest rates because mortgage rates are closely tied to the 10-year U.S. Treasury note.
The 10-year yield, okay.
So expectations of Fed cuts and lower Treasury yields are the biggest potential tailwind for this sector. On the inflation front, high construction material and labor costs, plus general inflation eroding purchasing power, are both negative for real estate.
Double whammy there.
Yeah. And the health of the housing market is a key economic indicator. A sharp downturn in housing can be a leading indicator of recession and trigger a risk-off move in broader markets. ##33. Investment sentiment outlooks and the web of influence.
So we've dissected each asset's dance moves. What does this all mean for their future outlook? Let's quickly review the current investment sentiment readings for each asset class as of September 1st, 2025. For stocks, we're looking at a 3.0 neutral mixed outlook. What's driving that particular view, given they're near all-time highs?
It's that exact tension we discussed. While Fed cuts are a potential tailwind, helping valuations, they're battling against already high valuations, that concerning narrow leadership and a clearly slowing economy.
Too many conflicting signals.
Exactly. It's a very delicate balancing act,
Yeah.
leading to that mixed outlook.
And bonds are at 4.0, moderately bullish. Is that simply a bet on the Fed cutting rates?
Largely, yes. The path of least resistance for yield seems lower, given that dovish Fed stance and slowing growth, which also positions bonds as a good hedge against a downturn.
Makes sense.
However, that sticky inflation we mentioned does temper the strong bullishness, as it could limit how much the Fed can actually cut. Hence, moderately bullish, not extremely.
Commodities back to 3.0, neutral mixed. I imagine that's because of the big split we saw earlier, gold versus industrial.
Exactly. It's a tale of two markets within one complex. Gold is bullish, benefiting from falling real rates and its safe haven appeal, but industrial metals and oil are more bearish due to global growth concerns and demand uncertainty. They cancel each other out for a neutral overall rating.
Then the US dollar's at 2.0, moderately bearish. Is that the most direct reflection of the expected Fed rate cuts?
It is a strong reflection, yeah. Interest rate differentials point to a weaker dollar, as the Fed is poised to cut. Its only significant support is its safe haven status during periods of global risk aversion, which can temporarily prop it up, preventing a strongly bearish outlook.
Cryptocurrencies also sit at 3.0, neutral mixed. Does that mean they're still beholden to those broader market forces, still tied to stocks?
Very much so. While they could benefit from falling real rates and increased liquidity, they're still highly correlated with risk assets. This makes them vulnerable to a hard landing scenario, where broader market fear outweighs the positive liquidity effects. A lot depends on that risk sentiment piece.
And finally, real estate is at 2.0, moderately bearish. That feels like a lagging indicator. Still digesting past rate hikes, maybe?
Precisely. It's still lagging due to those severe affordability issues and the slowing activity caused by high mortgage rates. While lower rates are a future tailwind, the current environment is dominant. It's likely to remain challenged until those rate cuts become a more concrete reality and filter through to mortgage markets.
Now, this is where it all truly comes together. Let's zoom out again and look at this as a dynamic map. What are the absolute gravitational centers, those few macro forces that really pull everything else into their orbit?
That's a great way to put it. There are, I say, 4 central influencing macroeconomic factors that act as anchors, subtly or powerfully, on all asset classes.
Okay, what are they?
First, Fed policy expectations, specifically that anticipated dovish pivot, is a truly powerful driver. It exudes immense downward pressure on bond yields, which in turn offers significant valuation support for stocks, even against slowing growth fears.
Right.
It also significantly pressures the US dollar lower and offers a crucial future tailwind for the struggling real estate sector as mortgage rates respond. That's huge.
Okay, Fed policy is number one. What's next?
Then there's the global growth outlook, which, as we noted, is slowing and divergent. This directly creates an earnings headwind for stocks and exerts bearish pressure on industrial commodities as demand wanes. Conversely, slowing growth can also lead to a flight to safety into government bonds, offering them support.
Growth outlook. Got it. Number 3.
Inflation trends, currently moderating but still sticky, act as a persistent constraint. It limits the upside for bonds by eroding real returns and, crucially, it handcuffs the Fed, limiting how aggressively they can ease policy. Within commodities, it provides important support for gold, which traditionally acts as an inflation hedge.
The sticky inflation problem. And number 4.
Finally, risk sentiment, which is currently cautious and feels like it's at an inflection point, is a major force. It makes speculative assets like stocks and cryptocurrencies highly volatile and sensitive to any shift. It also significantly impacts bonds and the US dollar, driving safe haven demand into these assets when fear grips the market.
Fed, growth, inflation, risk sentiment. Those are the big 4. And beyond those big macro currents, how do the assets themselves directly tug on each other? It's like a chain reaction, isn't it?
Absolutely. Think of it like this.
Yeah.
Bonds, with their yields pressured lower by the Fed, directly influence stocks because a lower discount rate makes future earnings look more attractive, which is quite bullish for equity valuation. The same applies to real estate, where those lower bond yields translate directly into lower mortgage rates, which are a major bullish factor for housing affordability and activity.
So bonds influence stocks and real estate significantly.
Very much so. Then the US dollar, with its bearish pressure from expected rate cuts, directly influences commodities through that inverse relationship we discussed, essentially making them cheaper for foreign buyers, which tends to be bullish for commodity prices.
Weaker dollar, stronger commodities.
Generally, yeah. And a weaker dollar is a powerful tailwind for U.S. multinational corporate earnings, offering support to stocks.
Interesting. And finally,
stocks, particularly the more speculative parts, have a strong positive correlation with cryptocurrencies. When general market risk appetite is high and stocks are doing well, Crypto often rides that same wave.
Risk on together.
Exactly. This whole picture, even just talking through it, really helps us see that these aren't isolated movements. They're all part of a larger, incredibly intricate, and constantly interacting system. Hashtag tag tag outro.
So, what stands out to you from this deep dive? For me, it's that incredible tension we discussed. The delicate balance between the market's strong expectation for Fed easing and the reality of sticky inflation.
Yeah, that's huge.
And then that ever-present soft landing versus hard landing debate constantly playing out across every asset we covered. It truly feels like we're at a pivotal moment.
If we connect this to the bigger picture, it reminds us that understanding these connections is absolutely crucial for navigating any market cycle. These relationships are dynamic, not static, and they're constantly evolving as new information comes to light.
Nothing stays the same for long.
Exactly. What looks like an isolated movement is almost always a ripple effect from elsewhere.
And that leads us to a final thought for reflection. Given these powerful, interconnected forces at play, especially the imminent Fed pivot against slowing growth and sticky inflation, how might a surprise piece of data in the coming days, say, unexpectedly strong labor numbers that defy the dovish narrative, or maybe a sudden surge in a crucial commodity price, completely realign these intermarket relationships we've been talking about?
Yeah, what would that domino effect look like?
And what would that mean for the outlook ratings we just discussed? Something to ponder as you look at the markets ahead.